Newfoundland. People with courage and foresight have come to mine this rich land for hundreds of years. Now, the next chapter in Newfoundland's mining history is being written. Newfound gold intersected 19 meters at 93 grams per ton. Some of the biggest names in the mining world now own over 35% of our shares. With over $70 million in working capital, Newfound Gold is well positioned for what the future brings. Find us online at newfoundgold.ca.
Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and joining me today is returning guest Danielle DiMartino Booth. She's the CEO, founder of Quill Intelligence, a former Federal Reserve insider, and the author of the book Fed Up. How are you today, Danielle?
I'm doing great, Tom, today. How are you?
Excellent. Thanks for joining us. I wanted to get some of your thoughts. You're obviously a very, very good macro analyst. So recently we've seen Powell saying that he's keeping the rates this low for years to come, and we're seeing deficit spending at all-time highs. These policies play right into the idea that you can afford to keep borrowing money as long as you can service the debt. What are some of the consequences of this type of monetary policy?
Well, it's kind of the monetary thinking, if you will. And if you consider that in 2016, for example, debt was 2/3 of what it is right now. And if you consider that 10 years before that, it was half of what it was. If you consider the trajectory of debt growth, then you have to start calling the Fed out for thinking that it can just continue to pile on debt at an increased rate and never, ever have to pay up in the form of inflation, higher interest rates. I think it's after what has been 1981 since we've seen interest rates coming down. And, now the benchmark is within 67 basis points of the zero bound on a nominal basis. So I think that the market is telling you that at some point there might be a flip switch when you move on from the natural deflation of having this many people unemployed to amassing so much debt that you end up with something more akin to stagflation.
Absolutely. There's a couple points there that I'd like to get to, but doesn't this type of policy really create more income inequality and stifle innovation?
Oh, gosh. I mean, two separate and distinct, but also related subjects. The Fed it is such a sad state of affairs that the Federal Reserve is so intent on Congress passing stimulus legislation because it's effectively run out of product. The Fed wants more treasuries to buy. And unless the Treasury is issuing fresh deficit spending, then the Fed is faced with a dearth of product issue. And the quantitative easing, the purchasing of those Treasury bonds, is what has kept the stock market levitated for as long as it's been. But it's done a whole lot of nothing for the 45% of Americans who don't own any stocks. So I literally cannot listen. I literally have to mute most Fed officials because, save Robert Kaplan of the Dallas Fed, none of them have owned up to the fact that Fed policy has exacerbated and widened the income equality divide. And it's literally intellectually insulting. So that's one side of what you're talking about. The idea of don't fight the Fed. Don't fight the Fed. Don't fight the Fed for investors means buy the index. Go passive investing. There's no reason to think that an active manager can get any value out of picking and choosing winners and losers based on the strength of their profits and cash flows and balance sheet. Don't fight the Fed also has fed, because of passive investing, the rise of U.S. monopolies, who by virtue of indexing naturally grow bigger and bigger for every dollar that is invested into an index or a passive fund. And so with the increased power that they have, what they end up doing, whether it's, Mother Microsoft or grandfather Google, whoever it is, if they see a competitor in a space that they're in or in a space that they want to be in, then they make this innovator a millionaire overnight and swallow up the future potential competition and become bigger even yet. As a result, the innovation becomes more and more insular inside of a handful of U.S. companies that, we're now seeing monopolization on a magnitude in a scope that rivals that of the robber baron era. There's nobody, there are no antitrust authorities in the country at this point.
Very interesting, Danielle. One of the things about the giant expansion that we've seen of the balance sheet that I want to get your thoughts on was basically the comparison between the US and, let's say, for example, the ECB's expansion of their balance sheet, and how if one goes further than the other, that currency wins.
So right now, what we're seeing and what is playing out in world markets, it's almost scientific. The country that is growing, the developed country, right? We're talking about the European Central Bank, Bank of Japan, People's Bank of China, Federal Reserve. The country that is growing its central bank's balance sheet at the fastest pace is able to devalue its currency most aggressively. And in recent weeks, the reason that Fed officials have been begging for stimulus spending is, again, that they've run out of product. At the same time, the European Central Bank has said, we're really going to ratchet up spending. And by the way, we're investigating the Fed's average inflation model to see if we can't also print more. They don't use those words. I'm paraphrasing. But the point is, when the baton handoff goes to the European Central Bank, in this case, the central bank with more wherewithal to print more than the losing country, if you will, that can't grow its balance sheet as quickly, they end up having an appreciating currency, which is exactly what we've seen with the weakening of the euro and the relative strengthening of the dollar.
Excellent, Danielle. As you're speaking about inflationary expectations, I want to get a couple of your thoughts on what we could kind of see going forward. Obviously, I know recently you spoke about that we're going to be basically dealing with either a deflationary or an inflationary environment, and we're going to have to kind of play it by ear to see how those two forces really start to play in here. But I wanted to get your thoughts on if we had a raising bond yield environment combined with low growth, what type of inflation does that create, and why is that one of the worst case scenarios?
So the 1970s is an era historically that you can look back on in which growth was slow and yet the cost to borrow was rising. So that worst case scenario, if you will, is called stagflation. And it's an environment in which gold flies high, but one also in which, the buying power is decimated at a time that their incomes are not growing. So that's the stag in stagflation. And the surest route to that is if the United States continues down this de facto socialism type of spiral where every few months the markets throw a hissy fit if Congress doesn't convene and pass another couple of $1 trillion in spending, as opposed to doing something that's productive and infrastructure spending that actually creates jobs, vocational training that helps out of work workers reskill. Instead of doing that, if you choose to go down this path of we're just going to keep throwing money at people to not work, then you're never able to get off of the treadmill of increased stimulus spending. So you don't generate escape velocity, you don't generate sustainable economic growth under such circumstances, and yet you're putting on so much debt that you are risking interest rates rising because people aren't blind, investors aren't blind to the tattering of your balance sheet if you're Uncle Sam. And at some point, they're going to demand higher compensation for the added risk of being so much more indebted than where you are. You could easily paint a scenario where we pass this next slug of stimulus, get close to $30 billion of debt in the United States, but you can easily paint a scenario where you can double that.
Absolutely, Danielle. And, today we're speaking on October the 1st. We're seeing all of the end of the second quarter job reports coming out. We're seeing lots of layoffs specifically from the airline industry. We've seen it from other industries like Goldman and like the insurance industry like Allstate. So what does that really indicate? All these loss of jobs, like how is this sustainable?
Well, that's the problem. And what you're describing is how you generate the stag and stagflation. And if you start to see economic growth that is sclerotic for a prolonged period of time, you cross the divide into demand destruction. And demand destruction is going to affect to a greater extent, in the case of the coronavirus, it's going to affect to a greater extent, not the individuals that are directly in leisure, hospitalities, restaurants, human-facing industries, if you will, that have been impacted by the coronavirus. You're going to get to what you're talking about, insurance companies, banks. We've seen major law firms announce cutbacks. Raymond James is another example that comes to mind. And that is when you start to see layoffs crawl up the income ladder. And once you peek into white collar layoffs, you have to do the math of consumption, right? Because the United States economy is 2/3 consumption. And within that dynamic, the top 2 quintiles of earners, if you will, the top 40% of income earners in America are responsible for 61% of spending, or 42% of US GDP. The risk we have, because these people are not on the receiving end of stimulus going forward, is that demand destruction turns into something that feeds its way back into the economy in the form of reduced and slowing consumption that then takes away even more lower paying jobs as a result, and it puts the economy in a vicious spiral.
Absolutely. And when you can't get those 2 top sectors of the population out spending money, because I know you were saying recently that they don't have any confidence in, let's say, masks or going out, that's what will really start to stagnate and drop the velocity of that money, correct?
That is absolutely correct.
So, Danielle, in your opinion, I'd like to get your thoughts on what might catalyze this next leg down. Obviously, if people aren't paying rent, there's going to be some type of a housing crisis. Landlords aren't getting paid. They're small business owners. We've seen lots of small business owners, restaurants, things like that, as you're saying, that are suffering as well. So could we see something like a housing crisis of sorts or a banking crisis start to really tip this next leg down for the system?
Well, I'm going to give you a non-answer there and say it depends. Some of the proposed stimulus legislation extends the eviction moratorium, extends the ability to attain forbearance. That will prevent a housing crisis, if you will. But what it doesn't prevent is the pain trickling down to the 48% of U.S. landlords who are small business owners. And that's the thing. There's no free lunch. The legislation is not logical enough, if you will, to say, okay, if we're in a period of true economic distress, we're just going to hit the pause button. It doesn't work like that, because if you hit the pause button, then you would say there's a moratorium on rent, but there's also a moratorium on the mortgage that the landlord has to pay. But it's not working like that. And that's why you're starting to see tensions build in the U.S. economy. Are we in the midst of a housing crisis with 15% of FHA mortgages 90 days or more delinquent, the highest since data was collected in 1979? We are, but we don't see it. It's invisible because banks have not been allowed to proceed with foreclosing on seriously delinquent homeowners.
It's another statistic that seems invisible, just like real inflation, and not how the Fed is actually trying to measure it and show it, right?
It absolutely is. And the fact that you've got 14% year over year home price inflation because the Fed has bought up 1/3 of the mortgage market, because FHA lending standards have completely collapsed in the face, and they still have 3.5% down payments, because Fannie and Freddie have ramped up what's called automated appraisal waivers when it comes to refinancing, such that $100 billion has been pulled out of home equity. I mean, we all remember you can't use your house as an ATM machine. None of us thought we'd get back here, and yet here we are with cash out refinancings going through the roof, predicated on lax lending standards and automated type of approval networks that came back to haunt Fannie and Freddie in the form of automated income verification. But now we don't have to verify the value of the house. We can just tell you that in that neighborhood, prices are going up by 14%, and therefore the house next door that's applied for refinancing should be able to take out that much more money. So we have a very artificially inflated housing market that is only driven by one fundamental factor of an exodus from urban centers. But other than that, it is being driven by Fannie, Freddie, the FHA, and the Fed.
Absolutely, Danielle. We recently saw the presidential debates as well, and Trump thinks that we have a V-shaped recovery. Biden thinks we have a K-shaped recovery. What would be the difference here? And are these an accurate representation of what's actually going on, in your opinion?
Well, I don't think there's a doubt in the world, given what I just described to you, as homeowners with good credit and access can pull out billions of dollars from their homes in terms of home equity and enjoy the fruits of the Fed pumping up the stock market. That's the 55% of Americans who make up the top portion of the K versus the bottom 45% of Americans who don't own any stocks and who rent because they can't afford to buy homes. And that's your bottom of the K. And again, that's why I advocate for infrastructure spending in lieu of simply throwing money at people, because you're not giving them a skill that's going to help them crawl out of the hole that they've been put in.
Absolutely. And, reskilling workers and education reform is something I know that you speak a lot about, and I'd like to get there. But, with the way that we've seen this last stimulus package come out, what do you think are the chances of something like UBI going forward? Obviously, we've seen the $1,200 a month to go and support people not to work while all these businesses were closed. So what do you think the chances of something like that coming are?
Well, I think that we're on a slippery slope because of the fact that the initial CARES Act provided that extra $600 a week without anybody really going to the chalkboard and doing the math and saying, oh my gosh, we're going to pay people a lot more than what they're making right now and disincentivize them from rejoining the workforce. If you perpetuate that and throw the same amount of money out in the form of stimulus, then you're going to end up fostering a class of Americans who prefers to simply get paid to not work. And you might just call it stimulus spending to address the acute unemployment problem in America. But what it becomes, if you continue to pay people to not work, is modern monetary theory, universal basic income.
Absolutely. And I think one of the things I'd like to highlight, you were saying recently that the past 6 recessions, disposable income had dropped by 0.5%. What happened in this recession?
Oh gosh, we saw it go up by, it was either 23 or 32% on an annualized basis. We've never seen anything like it. We did just get fresh personal income data out, and it showed that personal incomes had declined by 2.7% in the month of August. It's fairly lagged data, and that was just a reflection of the fact that August was the first month without that extra $600 per month. So there's so many things wrong with what Congress is doing. But the purpose, I think right now, it's extremely unfortunate that we're this close to a presidential election, because I think a lot of decisions are being made in Washington so that one party or the other can attain their goals when it comes to November the 3rd. But what they don't realize is that the patterns that are being created, once the government spends money on something, it's almost impossible to turn back the hands of time. So what we're doing right now in the name of a crisis ends up becoming endemic and changing the actual makeup of the U.S. economy and whether or not there is a future here for capitalism.
And you're kind of hitting on the exact point of where I'd like to go next. So, these policies that Washington is enacting, do you think that it's really pushing the electorate towards the left and more of these socialist policies and really just making them hungry for more stimulus and more left-leaning policies like this?
Well, look, I'll give you a historic example. I've just written 5,000 words on Japan. In the aftermath of World War II, there was a risk, because it appeared that the Chinese Civil War was going to end with the communists prevailing, because the Russians had supported the creation of North Korea, and because there was a financial crisis in Japan in 1947, late 1947, early 1948, it looked as if a financial crisis in Japan could potentially give rise to the nascent Communist Party in that country. And here comes the Korean War. And quoting U.S. officials from way back when, they said that the Korean War was the best thing that ever happened to them, because they were able to shift the thinking in Japan back to the industrialization of the country, because there was actually an end consumer for the products that they had created, which was the U.S. Army, by the way, the U.S. military. And Japan ended up producing, because of supply chain issues, getting munitions and supplies all the way from the United States over to South Korea, where the United States were fighting. It ended up being much more logistically sensible to get it from 80 feet across a strait from Japan, but that ended up preventing Japan from joining the rest of East Asia in communism and saved the region, if you will. Now, I provide that example, that historic analogy, to say that Americans will naturally be find universal basic income and being paid by the government appealing if there's not a different alternative that's presented to them in the form of increased vocational training, which occurred in Germany in the aftermath of the financial crisis, and or infrastructure spending that actually puts people to work. If you train people to say, I have to put my hand out and ask the government for subsistence or my family is going to starve, of course they're going to demand that. But again, these are very real world consequences that affect the future of U.S. sovereignty that are being made now under the auspices of the fact that we're within 30 some odd days of a presidential election.
Yeah, it is kind of depressing, Danielle. But for those of us that are really trying to educate ourselves and try and see what's coming over the hill here, can you give us some ideas of some of the best assets to own right now to protect our wealth, to really try and save some of the purchasing power that we're going to lose if we end up in a very hyperinflationary state?
Well, again, the hyperinflation, I think, comes much later on in the process, if you will, and you're going to have to align the stars to where a lot goes wrong. I think stagflation is the more likely candidate after a prolonged period of deflation, mind you. You don't get anything but deflation when you've got 26.5 million Americans collecting unemployment insurance in some form. That is only deflationary in nature, period, end. There's no pricing power to be had. You can need to raise prices, but you can't do it with this many people who are unemployed, period, end. But under a scenario, even in deflationary times, if there's economic disruption, and especially in stagflationary times, your precious metals are going to be the absolute most valuable. And other than that, it would be a good time to start thinking in terms of after residential real estate has its correction, when lenders are finally allowed to foreclose, that you start looking into the aftermath of the decline in housing for the hard asset you want to call home.
Excellent, Danielle. Do you have any thoughts towards, once we get through that part, maybe some indicators on when we would actually want to sell and get out of the precious metals?
Oh, gosh. No, in a million years, I can't tell you what's happening 4 or 5 years from now or 3, 4 years from now. No, I can't do it. My crystal ball doesn't go out that far.
Not a problem, Danielle. We'll have to see it as it develops, right?
I think that's the case. Bearing in mind, Japan is the only country that's been engaged in quantitative easing for longer than the United States. So for anybody who thinks that they've got a historic precedent to look back on, they're wrong. And you should call them out as being wrong. So we're in uncharted territory, and it's extraordinarily difficult to say where this is headed, given a decade, 2 decades ago, the second largest country in the world was Japan, not China. So a lot can change in the space of several decades, and it's almost impossible in such a situation to predict the future.
Excellent, Danielle. Do you have any final thoughts you'd like to share with us as we wrap up here?
No, I just... For anybody listening who doesn't follow me on Twitter, please do at DiMartino Booth and have a look at my website, Quill Intelligence. We produce the most unbiased, independent research on the street.
Absolutely. And those are both excellent resources for lots of great information. Danielle, I want to thank you very much for your time today.
I appreciate yours. Thank you. Take care.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?